diversification look like? Well, you should have some, 10-year treasury notes, or if they're a little too volatile for your taste, look at a 5-year note or a 2-year note. That will basically give you very, the credit secure. I'm not doubting the credit of the United States, but that will give you a deflationary hedge. If we get into disinflation and deflation where interest rates are coming down, which I do expect, you're going to get very good capital gains on those notes, or you're going to be very happy with the coupon in the meantime. Real estate, definitely. Not so much commercial real estate, too soon for that, but multifamily housing, residential real estate, farms, other kinds of income producing real estate for a slice. Good slice of cash, maybe as much as 30%. People hate cash. They go, I don't get a yield on cash. Cash is a waste of my time, etc. It's true that it has very low yield, but number one, it performs very well in deflation, which we talked about. But more importantly, cash is the opposite of leverage. It reduces the volatility of the rest of your portfolio. So if you have volatile investments in the wings, cash is it's like a bar connecting to two ends of the barbell. It has very low volatility, but most importantly, it gives you optionality. If you see stock markets crashing and burning the way I expect, the way I described, the person with cash can go out and go shopping in the ruins. And by the way, Berkshire Hathaway has over $130 billion in cash. Why does Buffett have so much cash? Well, he sees what I see. We're looking at the same thing, which is a kind of meltdown where the person with cash can basically go shopping for bargains. Definitely a slice of gold for the reasons we talked about. That'll be your inflation hedge. But 10%, people always say, Jim Rickards says, sell everything and buy gold. I've never said that. I don't think that's a good idea. But 10%, yes, that's a good slice. Private equity, if you can have access to good deals, that's a separate category. And so a model portfolio, you'd have a slice of treasury notes, a slice of cash, have some stocks, but I would focus on, for example, energy, BP, Exxon, Mobil, Shell, Marathon, this Green New Scam thing, forget it. It's a big deal, from a policy point of view, but it's infeasible. I've studied the science very closely. It's going to go away. But in the meantime, if you bash the oil and natural gas companies, but you're going to need the oil and natural gas, which we do, then those stocks are going to do well. Real estate, I mentioned, and gold. So that would be a really diverse portfolio that would have 5 or 6 different asset classes. And some will outperform others. Some will do better in inflation, some will do better in disinflation. But that's the whole idea with this much uncertainty. And winners will outnumber your losers. And cash is like a thermostat. You can reduce cash and buy a little more gold, or reduce cash and buy a few more stocks if that's warranted. So that's what I think an ideal portfolio is. The future is very positive for gold. You have the normal vectors. Supply is flat, but has been for 6 years. Demand is going up. Central banks have flipped from net sellers to net buyers. That's a big deal. Retail and institutional interest is higher, so that's good. Geopolitical threats, don't need to say a lot. From the U.S. perspective, Iran, China, North Korea, Venezuela, Russia, you name it. So that's the vector. But the biggest driver right now is what I referred to a few minutes ago: negative real rates. Because gold, as a form of money, which is how I view it, competes with other competes with other instruments, treasury bills, etc. Well, if they have high yields and gold has no yield, you want the treasury bills. But if interest rates have negative yields and gold's just flat, gold looks more attractive. So that's the main driver, and that's going to continue. Everyone's like, well, the gold is up, gold is down. So what do you mean when you say that? And they're talking about the dollar price of gold. And it's like, okay, so the dollar price of gold is up or down. That's really a cross rate. That's no different than talking about the euro-US dollar exchange rate or Australian dollar-US dollar exchange rate. If you think of gold as money, and I do, then the dollar price of gold, with gold measured by weight, not as another currency, it is another form of money, but with gold measured by weight, it's a cross exchange rate. When the price goes up, I would say that what's really happening is the dollar is going down. In other words, I think of gold by weight. I'm interested, do you have a ton? Do you have 50 kilos? Do you have 5 ounces? Whatever you have as an individual investor, as a bank, I think of it by weight. Because when someone says gold's really going up, I said, well, no, the dollar's going down. You need more
dollars to purchase a fixed quantity of gold, which means the dollar is worth less. And when people say gold's really going down, I say no, the dollar's worth more, and you need fewer dollars to purchase a quantity of gold. In other words, when people talk about price, the first thing they do is they're really talking about dollars. There's a euro price for gold, but the world market is based on dollars. You're privileging the dollar as the numeraire. The numeraire is your counting system. Is it yards, inches, feet, whatever? And if you put the dollar first and say gold is in dollars and it's going up or down, I think you have it backwards. I think you need to put gold first by weight. And then if it's worth more, the dollar's going down. If it's worth less, the dollar's going up.
And so when you say gold is going up, let's say it went to $2,000 an ounce, everyone say, oh, the price of gold went up, just went up 10%. Well, did it, or did the dollar go down? The way I would phrase it is, it used to be $1,800 to get an ounce of gold. Now it's $2,000 to get an ounce of gold, or, your dollar got you 1/1800th of an ounce. Today, it only gets you 1/2000th of an ounce. In other words, gold didn't do anything. It's a metal, it's an element, atomic number 79. What happened was the dollar got stronger. So a stronger dollar is a lower dollar price for gold, and a weaker dollar is a higher dollar price for gold. So when people talk about gold going up, what they're really talking about is the dollar going down.
We have new numbers regarding how much gold central banks are buying, 400 tons in Q3 this year, records and numbers we haven't seen since the 80s. Yet we don't know some of those mystery buyers. Obviously, the theories are they are Russia and China.
Now China is non-transparent. Russia is much more transparent, although Russia is starting to be opaque a little bit because they're in a war. But you can see the inflection point is 2010. So from 1970 to 2010, it's a long stretch, 40 years, central banks were net sellers. It didn't mean everybody sold everything, but Switzerland's down 1,000 tons, U.S. was down 1,000 tons after losing 8,000 tons, or sorry, 11,000 tons between 1950 and 1970. It was down, down, down. 2010 was the year that central banks became net buyers. Now, it doesn't mean every central bank was buying gold. It does mean that they were selling a lot less and others were buying more. And some of the buyers are Mexico, Kazakhstan, Philippines, Vietnam. We know China's a big buyer. We don't know exactly how much. Russia was a big buyer. That is continuing. Now the new players, Iran's non-transparent, but we know they're buying gold. Turkey is buying a lot of gold. Japan had a bunch of gold all along. They never told anybody about. Literally 1 month, their reserves went from 600 tons to 900 tons. Well, the market. You can't buy 300 tons in a month, not one country in one order. But they had it all along, but they decided to reveal it, put it on their balance sheet. So Americans don't seem to like gold. I'm not sure Canadians feel much differently, or others around the world. But central banks sure do, and I think that tells you something. There's huge demand for dollars all over the world, not because of the currency, but because of collateral, because of treasury bills. Banks need treasury bills to pledge as collateral for derivatives. It's the best collateral in the world. And if you don't have it, you're not going to be able to leverage your balance sheet as much as you would like. You're not going to be as profitable. You're not going to be able to support lending and investing, which is what banks in theory are supposed to do. To support the bloated balance sheets and to support the derivatives, you need collateral. And the better the collateral, the more leverage you can have. The best collateral in the world is a treasury bill. And so there's a mad scramble for treasury bills, which means there's a mad scramble for dollars to buy treasury bills. And that is coming from European banks, it's coming from Chinese banks, and banks around the world, but primarily European and Chinese. And that's not going away. So it's funny to hear people think it's funny to hear anyone talk about a dollar collateral shortage, like, hey, haven't you flooded the world with dollars? Hasn't the Fed printed $9 trillion? And the answer is they have. But that's not the measure. It's a high multiple of that. It's the dollar value of all the collateral. Because in the repo markets, I pledge the collateral to you, and then you pledge it to somebody else, one of our colleagues, and then she pledges it to somebody else, et cetera. That collateral gets pledged 50 times and supports not $1 a balance sheet, but $50 a balance sheet for $1 of collateral. And so you restrict the collateral, you're restricting the balance sheet. The dollar as a reserve currency will not be deposed overnight, but as a payment currency, there's a difference between a reserve currency and a payment currency. Anything can be a payment currency. If I want to pay you with baseball cards and bottle caps and you're okay with that, then it's a currency.
So all of these organizations are working on new payment systems right now, and they're going to start to roll them out this year and later. So that's going to be a radical change in how we pay for things. I can give you 20 reasons why the dollar should go down, but I'll give you one big reason why it won't, which is the demand for collateral. And so that's keeping the dollar constant, which is keeping the dollar price of gold constant, because gold doesn't change and the dollar's not changing. Now that'll break, and that'll break in favor of gold, meaning the dollar will get a lot weaker. It'll have to, but it's going to take a few months at least, because the U.S. economy has to get weaker, which it is. The Fed will figure this out maybe by September, next September. And then they'll ease a little bit and they'll try to weaken the dollar to try to give the U.S. economy a boost, but we're not there yet. So it's going to be, now that doesn't mean the price of gold is going down a lot. I'm just saying it's not going to go up a lot. It's going to chug along kind of sideways, but when it breaks, it's going to break big to the upside because the dollar is going to go to the downside, but that's probably at least still a few months away, maybe longer. Just at a very high level, I would say that there are a lot of difficulties, a lot of challenges. We'll talk about all of them in detail. You know, people put words in your mouth and kind of get the reputation as this doom and gloom guy. You know, Jim Rickards is always talking about the end of the world, which I don't. I never use that expression. But I make the point that, yeah, despite the difficulties, we don't have to be victims. We're not helpless. We don't have to curl up in a ball. The key is to see it coming. If you can see things coming, you can deal with them accordingly. You can get through them, not only preserve wealth, but actually make money. I always point out the example of Hugo Stinnes, and people go, who's that? He was an industrialist in Weimar, Germany in the early 1920s, and he could see the hyperinflation coming long before the middle class, long before anybody else. He went out and borrowed an enormous amount of Reichsmarks, that was the currency at the time, and just bought industrial assets, coal mines, vessels, natural resources, etc. So here comes the hyperinflation. He gives it a little time. He pays back his debts. I would say pennies on the dollar, like a millionth of a penny on the dollar, in other words. But he paid it back. They were sweeping the money down the sewers, but he paid back his debts and kept all the assets. And he became the richest man in Germany. And my German's not very good, but his nickname was the Inflationskönig, which means the inflation king. So there are other stories like it, Joseph Kennedy in the 1929 crash, but here's a guy who lived through the greatest hyperinflation of any modern industrial economy and ended up as the richest man in Germany because he saw it coming and made the right move. So again, we're not helpless. We can do things about it. But the key to empowerment, as I say, is to see it coming. That's where the analysis comes in. And you're like, gee, Jim, are you smarter than everybody else? Of course not. There are a lot of big brains around, but people have flawed models. There's a lot of behavioral psychology behind it, the confirmation bias or believing the future will resemble the past, which it usually does not. And so if you're going to stick to those models, you're going to get really bad results. It's hard to think of an institution that has a worse forecasting record than the Federal Reserve, the U.S. Federal Reserve, with the possible exception of the IMF. They're both pretty bad. I mean, you could almost take the Fed forecast, do the opposite, and be just fine. There's more to it than that, but they just stick to these really bad models. But if you understand how the economy really works, if you understand it's a complex dynamic system, all I've done is I've taken complexity theory, which has been around for a while. I mean, you can say 13 billion years because the Big Bang was the ultimate complex dynamic paradigm shift or phase transition. But the science of complexity, understood in mathematical terms, really dates to the early 60s. But it's been used very successfully in physics. It has a lot of applications. All I did was bring it over to capital markets. I looked at capital markets and said, wait a second, here's one of the most complex dynamic systems you can picture. And then there's nothing more complex than the human brain. So you're putting humans on top of capital markets. You've got complexity squared or some exponent. And those models work brilliantly. But try getting anyone to understand it or do that work is difficult. But again, the point is, if you have the right models, and I would include behavioral psychology, a good dose of history, complexity theory, and a few other branches of applied mathematics, you can get very good results. But if you stick to, the Phillips curve and non-accelerating inflation, unemployment rate, and a lot of other nonsense the Fed uses, you're gonna get it wrong. Does the future resemble the past?
with some probability, some degree of distribution of probability. Not always. I mean, and maybe less frequently now than ever. And they also assume that prices move continuously. Prices go up and down, of course, but markets don't move continuously. Or if they do, it's when you don't care. When you do care, they just gap. They gap down or they gap up. You miss it, you blink, and it's at a completely different level. It's been repriced. Now, you can still get in and out, but you've either made a lot of money or lost a lot of money, in the blink of an eye. So when you take those characteristics, and this is how I started kind of, deconstructing it, if you will, and said, well, look, markets are not efficient. That's nonsense. They don't move continuously and slowly. They gap up and they gap down. And if you're not ready for that, you've missed the boat. Nothing's risk-free. So why don't we start there? When I started identifying those factors that, in my view, were incorrectly applied, and you say, well, what looks like that? Well, the answer is a complex dynamic system. A system that produces hurricanes and tornadoes and lightning bolts and power outages and earthquakes and tsunamis. Those are all examples of the results of complex dynamic systems. An earthquake doesn't sneak up on you. The ground falls out from under you instantly. And that's what happens in markets. So then I said, well, maybe that's a better model. Of course, it is. Things evolve all the time. Another tool, intellectual tool, applied mathematical tool, uses Bayes' theorem without getting too much in the weeds. And I learned Bayes' theorem at the CIA because I always say, if you have all the facts, a smart high school kid can solve the problem. The intelligence agencies and others and people in capital markets have to solve problems when you don't have all the facts, but you have no choice. In national security or defense, it's literally life or death. On Wall Street, it could be your fortune or your client's fortune. So you don't have the luxury of just throwing up your hands and say, well, I'm going to wait till I get more facts. That's what Janet Yellen did, but that doesn't work in the real world. She's kind of detached from that. So how do you solve problems when you don't have all the facts you need to really solve the problem, and you know it, but you have to deal with it anyway because it's coming at you? Well, Bayes' theorem says assign an initial probability, a priori assumption. Just not make it up, but do the best you can, recognizing that you're going to fall short, that you've got missing pieces in the puzzle, if you want to put it that way. And if you have no facts at all, and it's a binary outcome, give it 50-50. It's not quite 50-50, but red or black on a roulette table, it's a little less than 50-50. It was close enough. You said it's either going to be red or black, don't know which. I'm going to give it a 50-50. And then what you do, and this is what statisticians hate, you update it based on subsequent facts. As new facts come in, you put them back in the model, you update it, and what you'll discover is that your probability either goes up or down. Well, if it goes down more than a certain amount, you discard it. You say, well, that's wrong. I just do it again. But if it goes up, what you're doing is making it more and more likely that your assumption was true. And so eventually you can get up to the 80-90% level. Now that's not 100%, but it's pretty darn good. But there's a tension, which is, okay, as you're updating, and this is something that was explained to me by Henry Kissinger. So imagine a simple graph, and the vertical axis, the y-axis, is the probability of a certain outcome, and the x-axis is a timeline. Basically, you convert that into the amount of information you have. How much information do I have? How much time do I have to make a decision? Well, at zero, at the outset, you have no information, or very little. But you have a lot of time. You have a lot of degrees of freedom. But as you move across the x-axis, as you move down the timeline, what you discover is you get more and more information, which is a good thing. So that curve is going up. But you have less and less time, fewer degrees of freedom. That curve is going down. So when you get all the way to the other end, it's like, hey, I have perfect information, but it's too late. It's over. I miss either, war started, or I lost all my money, or something bad happened. So what you look for is the sweet spot in the middle, call it the Kissinger cross, where I have enough information to be smart, but enough time to have degrees of freedom and be able to act. You look for that sweet spot in the middle, and that's when you act. And, with a little humility is a very good tool, a good addition to the. They, $9 trillion of QE didn't do any good. I mean, how does the Fed do QE? They buy bonds from banks, give the money to the banks, and the banks give it back to the Fed as excess reserves. What does that do for the economy? Nothing. Zero rates, again, it doesn't work. They don't have the tools. We've been talking about recession, inflation, deflation, but the one thing we haven't spoken about yet, and you kind of just referred to it, is there a global liquidity crisis coming? And a liquidity financial crisis is different from a recession. sometimes you can have one without the other. In 1990 we had a recession, there was no crisis. 1998 we had a crisis, there was no recession. The economy was fine in 1998, but the financial world almost came to an end. Sometimes they come together, and that's what happened in 2008. We may be looking at a scenario like that. By the way, 65 trillion in foreign currency derivatives, yeah, but try 1 quadrillion in total derivatives. I mean, that's foreign currency. That was the focus of the BIS paper. But when you get into interest rate swaps and commodity swaps and swaptions and all the rest, that's 1 quadrillion, which for people not familiar with the Q word is 1,000 trillion. So you pointed to 65 trillion, and you're right, that's FX, but there's 1,000 trillion or 1 quadrillion of derivatives off balance sheet of the banking system, supported by collateral, a little sliver of collateral, and there's a dollar shortage, and that's getting ready to implode. Well, a couple things you can do. One thing, I would increase my cash allocation. A lot of people hate cash. They're like, it doesn't have any yield. Why would I do that? I'm missing out on whatever, Bitcoin or stocks or whatever. Cash is extremely valuable. Number one, it performs very well in disinflation and deflation. Deflation, it could be even with a very low nominal yield, it could have a much higher real yield in the world when prices are going down. So it's a good deflation hedge. But more importantly, cash gives you optionality. If taking everything we just described about a potential stock market crash that could be 30% or more, a global liquidity crisis that could be worse in 2008. I mean, there are plenty of signs of both of those things. Well, if you're the one with cash, first of all, you're not going to lose money on cash. You will on stocks and other asset classes, but not cash. And then when this drawdown comes, when this collapse comes, you're the one who can go shopping. You can go out in the wreckage and say, oh, well, here's a good company. It's down 90%. I'll buy some of that. By the way, the person with the most cash in the world is Warren Buffett. Berkshire Hathaway has over $130 billion of cash. Now, why do they have that? The answer is Buffett sees the same thing I see, the same thing we're talking about right now, which is in a highly uncertain world with a lot of vulnerabilities, and that's exactly what we're describing, that come home to roost, and that's how I see 2023. Cash will preserve wealth and then give you the opportunity to pick up bargains. I'd also have a slice of gold. I recommend 10%. People always want to put words in your mouth. Jim Rickards says, sell everything and buy gold. I've never said that. I don't think it's a good strategy. 10%, yes. Now, if you have 10%, sit tight. It'll serve you well. If you don't, you might want to get some gold, because a lot of what we're talking about is going to play out in foreign exchange markets. In crypto, there's nothing there, but they've replicated this infrastructure. And so a lot of the wealth that's been generated in crypto is because you own a crypto exchange, or you own a lender set. Now that's all imploding. It's kind of a replay of 2008, except instead of Bear Stearns, Lehman Brothers, Fannie Mae, Freddie Mac, and Morgan Stanley was hanging by a thread. It's FTX most prominently, but Genesis is kind of considering bankruptcy, etc. So all that is collapsing. So Bitcoin's not an exchange. It's not part of that infrastructure. It's just a coin. The best analogy I've been able to come up with, I have a lot more to say about it coming out of communications theory, but it's like a casino chip. If I walk into a casino, put my money on the roulette table, and the croupier gives me chips, I can gamble them, I can play with them, I can make money or lose money, but when I leave, I go to the cashier and get my dollars back and walk out. If I take the chips outside the casino, they're worthless. I can't pay for dinner with casino chips. So cryptocurrencies are casino chips. You're in the crypto casino. Some people made a lot of money, and I know some of them personally. A lot of people have lost a lot of money. More have lost than made money, which is how casinos work, by the way. So eventually they'll all go to zero, but in stages. But what's collapsing right now is the infrastructure. China's non-transparent. Russia is much more transparent, although Russia is starting to be opaque a little bit because they're in a war. But you can see the inflection point is 2010. So from 1970 to 2010, it's a long stretch, 40 years, central banks were net sellers. It didn't mean everybody sold everything, but Switzerland's down 1,000 tons, the US was down 1,000 tons after losing 8,000 tons, or sorry, 11,000 tons between 1950 and 1970. It was down, down, down. 2010 was the year that central banks became net buyers. Now, it doesn't mean every central bank was buying gold. It does mean that they were selling a lot less and others were buying more. And some of the buyers are Mexico, Kazakhstan, Philippines, Vietnam. We know China's a big buyer. We don't know exactly how much. Russia was a big buyer. That is continuing. Now the new players, Iran's non-transparent, but we know they're buying gold. Turkey is buying a lot of gold. Japan had a bunch of gold all along. They never told anybody about. Literally in 1 month, their reserves went from 600 tons to 900 tons. Well, you know the market. You can't buy 300 tons in a month, not one country in one order. But they had it all along, but they decided to reveal it, put it on their balance sheet. So Americans don't seem to like gold. I'm not sure Canadians feel much differently, or others around the world. But central banks sure do, and I think that tells you something. They're preparing for what we're talking about, which is a world where the dollar as a reserve currency will not be deposed overnight. But as a payment currency, there's a difference between a reserve currency and a payment currency. Anything can be a payment currency. If I want to pay you with baseball cards and bottle caps and you're okay with that, then it's a currency. So when we see the BRICS Plus, the Shanghai Cooperation Organization, OPEC Plus, China individually, all these countries are the Eurasian European Economic Union, which is Putin's answer to the EU. All of these organizations are working on new payment systems right now, and they're going to start to roll them out this year and later. So that's going to be a radical change in how we pay for things. The thing is, people don't understand reserve currency. It's not as if the People's Bank of China has pallets of $100 bills stacked up in the basement. Reserve currency means a currency of denomination of securities. So what China does have are treasury bills and treasury notes. So the key to being reserve currency is not the currency, it's the bond market. Do you have a large, safe, liquid bond market? And if you do, then people will buy those bonds. What else are they going to do with the money? But that's much harder to replicate. Well, they can't have a currency backed by gold, at least not the Chinese yuan, because the problem is there is no Chinese yuan bond market of any size, number one. Number two, they have no rule of law. I mean, no, I wouldn't trust the Chinese or the Russians for that matter. And the U.S., the problem with the U.S. is that we had a good thing going. I've always said the world will not destroy the dollar. The United States will destroy the dollar through our own policy blunders. And when you freeze the assets of the Central Bank of Russia, I don't want to debate the war in Ukraine, that's a big subject, but when we freeze the assets of the Central Bank in Russia, and you're the Central Bank of Turkey, Saudi Arabia, China, you're like, hey, how do I know that next week the U.S. isn't going to not like something I did? Are they going to freeze my assets? So little by little, yeah, at the margin you get out of. The Silicon Valley Bank was taken over by the regulators on March 10th, but you can see it coming. It was in distress. There was $40 billion pulled out of that bank in one day on Thursday, March 9th, the day before it was taken over. $40 billion just hit the road, just left. It was a complete collapse. And then you get all the corruption, insiders selling stock before the crash. Mary Daly, the chief regulator, president of the Federal Reserve Bank in New York, she's running around doing LMNOP plus and pride flag and all this stuff. Fine, that's it's a free country. You can do that if you like, but she wasn't running the bank, and she knows nothing about risk management. She's a labor economist, protege of Janet Yellen, came up the ranks, but knows nothing about risk management or actually running a bank. So it just got worse, and then here comes Credit Suisse, right? The entities are always different, the currencies are always different, but the dynamics are very much the same. And the one thing I can say to our viewers is that this is not over. There's been a little bit of a sigh of relief. Stock market rallied a little bit toward the end of beginning of April. And okay, that's a normal reaction. But any thought that the problem's been solved, the bailout's complete, you're not going to hear more, is just not true. There's more coming. Get ready for it. I'm just saying that there are more dominoes waiting to fall.
As you may have noticed, as we're going into a recession, and I suspect unemployment's going to scream. I see more people here in Arizona standing on street corners and all this saying, veteran, please give me $1 or something like this. And I just can't believe they're wasting their time begging for money. This guy was a pretty young guy standing on the corner begging. And it's not good. So we're heading back, I think, into the 1920s. Very good chance we're in the middle of a drought right now. This is a 90-year cycle in bad weather.
The really interesting part about this, and again, we can come back to the specifics, is that the dominoes falling is a good metaphor. It's, if you got 100 dominoes, you knock the first one, they're all going to fall. That's just physics. So how do you stop that? How do you stop that crisis? Well, you truncate, you drop a steel wall between two dominoes, and this one hits the wall and this one's still standing. But that's the bailout. But the problem is each crisis tends to get bigger than the one before, which means each bailout gets bigger than the one before. My question that I'm wrestling with, are we now at the point where the needed bailout is bigger than the capacity of the central banks?
Today, everything's changing so rapidly, but this time the tom-tom beats are getting louder and louder and more do it now, basically. My concern today is for Kim and I, our real issue is social unrest. The gap between the rich and poor is now excessive. And that leads to revolution, civil rioting, and all this. When you print all this fake money and you rig it for the rich only, what that produces is a wave of intensified and widespread social unrest, disjointed political upheaval, dangerous extremism, punishing trade wars, and sweeping isolation.
The crash we see is in the commercial business sector. Again, the higher interest rates go, the more money people have to pay on their loans, particularly if they're variable, which, by the way, just happened up in Canada. They got a lot of variable interest rates up there, and they just raised the interest rate there 50 basis points. So we believe, we're forecasting, the big downturn is going to happen in 2023. It takes time for this stuff to take hold. But then don't worry about it, because when 2024 comes, they're going to lower interest rates in the United States in time for the presidential reality show.
The most important thing today are credible sources. And now the alarm is getting louder as technology changes. We have to go to a solution pretty quickly because people are on suicide watch right now. Well, first of all, everybody can do something, but they won't. And that's the problem. The reason, who stole my pension, there was plenty of money in it, but nobody did anything. They just stole it. The people did nothing. It's like I said, when the crash came in 2008, not one of those guys went to jail. They got paid bonuses. So there's something rotten inside America. And I think the problem with many Americans is they're complacent. They expect, well, it'll heal itself again.
The higher these interest rates go, all the people with adjustable rate mortgages, all the businesses that borrow money that have variable rate mortgages, the governments that are deep in debt now paying more because interest rates are going up. So yeah, the equities are going to go up, but this economy is going to keep going down. And it's going to go down big, and it's going to go down hard. Not right away, but it's going to progressively get worse and worse and worse. UK traders now expect the BOE's next rate rise to be its last in the cycle. And in the Eurozone, markets expect rates to peak at 3.25% in the summer, up from the current level of 2.5%. 2.5% when you're looking at inflation rates in the UK and the EU that are killing the people. These interest rates are nothing compared to inflation. So when you put the inflation numbers compared to the interest rates are still deep in negative territory. It will prop up the equity markets, but the economies are going to go down.
The question I ask people is, if we go into a depression, how will you do? That's the question. So I set it up since 1971 when I saw Nixon take the off the gold standard, and I started getting smarter. So I'd say, I don't trust my government. Like, don't fight the Fed. And I was like, can the Fed print oil? Can it print gold? Can it print water? Can it print food? No. But people go, oh, don't fight the Fed. So the thing I always say is, in a worst case scenario, how will you do? So that's why I own oil wells, not oil stocks. I own cattle for the food. I own gold mines. I own my own company. My company, Rich Dad, did better in the downturn than ever before. So it's not recession proof, but people wake up more and they say, I better get financially educated. And I never stopped studying. It's the most important thing you can do. Problem with Americans is we're dysfunctionally optimistic. We live in a don't worry, be happy world. And that's not the real world.
So now we're dangerously close to the point where as the crisis gets worse, it's no longer, oh, gee, let's wait for the Fed to bail it out, or let's wait for the ECB to bail it out. You get to the point, I think we're there, where you say, no, these guys actually can't stop it. And you lose confidence in the currency itself. The crisis is the dollar itself, and there's no way to bail out a dollar crisis. Recession and unemployment's going to go up. Sorry about that, but we've got to get inflation under control. So is inflation here? Absolutely. It's in Australia, it's in the United States, Europe. You see it all over the world, actually. Even Japan, which has suffered from deflation more often than not, is seeing inflation of about 4%. That may sound low to an American or an Australian, but that's sky high to the Japanese. So they're feeling the price shock as well. So it's real and it's here. It means that you may not like the price, but you have no choice. You've got to go to work, take the kids to school, deliver goods, use your truck and your job, whatever it is. You have to do it. You have to pay that higher price. But it means that $75 extra at the pump, maybe twice a week, so $150 a week. That's $150 you don't have to spend on something else. Could be concert tickets, a show, dinner, a new dress, a new suit of clothes, whatever it might be. You're not going to buy that because you've just spent that much money on the gasoline. Well, that means all those other industries suffer. Retailers have lost sales, restaurants have empty tables, concerts have empty seats, and so forth across the entire spectrum of goods and services. Well, soon enough, that results in layoffs, some business failures, price cuts, etc. And that disinflationary and deflationary trend ends up in a recession. So this is unprecedented. It's never been this high. It breaks the pattern of running it up in war and paying it down in peace. No one roots for war, but they happen. And it's worse than that because of modern monetary theory. People say, well, Bitcoin's not backed by anything, or the dollar's not backed by anything, or the euro's not backed by anything. And I say, yes, they are. They're all backed by the same thing, which is confidence.
Right.
If I think something's money and you think it's money and I tender it to you for goods and services and you think you're confident you can give it to Francis for goods and services and we have a large enough group, it's money.
Right.
It can be, we were kids, we did this with baseball cards and bottle caps, so anything can be money if there's confidence. But confidence is fragile. It's easily lost. And when you lose it, it's very, very difficult to regain. So how do you survive that? What's the optimal asset allocation method? Well, the key is diversification. You may have 50 stocks, but you have one asset class, which is stocks. And they're all going to go down together or go up together, as the case may be. But particularly in times of stress, they become highly correlated. So having 50 different stocks or ETFs or whatever is not diversification. That's just having a whole bunch of bets in one asset class. So what does real diversification look like? Well, you should have some, 10-year treasury notes, or if they're a little too volatile for your taste, look at a 5-year note or a 2-year note. Real estate, definitely. Not so much commercial real estate, too soon for that, but multifamily housing, residential real estate, farms, good slice of cash, maybe as much as 30%. People hate cash. They go, I don't get a yield on cash. Cash is a waste of my time, etc. Cash is the opposite of leverage. It reduces the volatility of the rest of your portfolio. So if you have volatile investments in the wings, cash is it's like a bar connecting two ends of the barbell. It has very low volatility, but most importantly, it gives you optionality. The answer is diversification. Everyone goes, oh, we know that, diversification. But they know the term, but they actually don't know what diversification is. And I'll give you an example. I run into people all the time. They go, well, Jim, I'm fully diversified. I have 50 stocks in 10 different sectors, telecommunications, semiconductors, consumer non-durables, metals and mining. And I go, you're not diversified. You may have 50 stocks, but you're in one asset class called stocks or equities. And they're all going to go up together or they're all going to go down together. And the more stressful the condition, the more reason you have to be concerned about it, the higher the correlation. On any given day, some stocks go up and stocks go down. But when you dial the stress meter up, they all tend to move together.
You brought up chapters 1 and 2 from Currency Wars, where you basically highlight this scenario. You said the scenario you presented at the time was that Russia and China would accumulate large gold reserves, pool their gold, and launch a new digital currency backed by gold in the place of the US dollar. Is that the form it would take for you, something backed by gold?
Probably, and here's why. And by the way, when I wrote that, and when we did the war game, and when I wrote that, Russia had about 600 tons of gold, and today they have 2,300 tons. China had about 600 tons of gold, and today they have about 2,000 tons, just slightly less, that we know of. And they may have several thousand tons off the books in the State Administration of Foreign Exchange that we don't know about, because that's completely opaque. So Russia and China did exactly what we warned the Pentagon about in 2009, exactly, which is increase their gold reserves by a factor of 4 or more. But everyone's like, well, the Chinese yuan is going to be the global reserve currency. No, it's not going to be the ruble. But here's why. Well, there are a lot of reasons, but the main reason is when you talk about reserve currency, you have to understand what that means. It's not like the People's Bank of China has a bunch of $100 bills on pallets stacked up in the basement. When people say reserve currency, what they really mean is the currency of the bonds that they invest in. In other words, they're dollar-denominated assets in the form of treasury bonds or notes. That's what China actually has on their books, not like the dollars per se. So if you want to suggest or hypothesize that the Chinese yuan is going to replace the US dollar as a global reserve currency, where's the yuan bond market? I mean, it doesn't exist. Very small scale, very illiquid, no primary dealers, no win issue trading, no auctions, no repo, no settlement clearance, none of the plumbing and the mechanics of a mature bond market such as the United States. And above all, they don't have a rule of law. I mean, at least if somebody reneges on a treasury bond, you can sue somebody, but you can't do that in China. So the absence of the rule of law, number one, the absence of the infrastructure, the plumbing, for want of a better word, are two reasons why the yuan and certainly the ruble will not replace the dollar as reserve currency. However, what I was hypothesizing then, and I'd come back to this, is you can create a brand new currency that does have all that stuff. And in my example, they used a Swiss bank, UK law, put the gold in a third-party depository. If you wanted some of the new currency, you could deposit your own gold and get some of the currency or trade with them or run a surplus. So it was a replacement system, but you would need the gold to instill confidence. But they don't have bond markets, so they're not going to have them soon. So the yuan and the ruble aren't going to replace anything.
In the terrifying picture you've just painted, Jim, how should we be protecting ourselves here?
Well, you want assets that are going to be immune from a global liquidity crisis. What are they? Land, real estate, gold, silver, fine art. I see Andy Warhol, Marilyn Monroe has gone. They estimate $200 million. You could have bought that for $50,000 in the 1970s. That's a little more specialized, but there are, natural resources, water, et cetera, energy, oil. If you want to be in stocks, okay, get stocks of companies that are based on natural resources, such as ExxonMobil, Chevron. I mean, I'm just giving these as an example, but, so there are a lot of ways to protect yourself, but, a regular stock portfolio is not a good one, and banks are going to be in distress. Money market funds are going to be in distress. That's what a liquidity crisis is.
We seem to have a huge chunk of our working age population that is not working, and you probably study this more than most people. Like, what's truly going on there? Do we have is it just an aging population that truly can't work? I know that disability has seen massive growth over the past 15 years. Are there a bunch of people that are opting out or gaming the system or whatever? But what's responsible for us only having 62% of our working age population actually engaged in working?
Well, there are two answers to that, but they're consistent. I'll give you both. The short answer is it doesn't matter. You listed a number of factors. I'll go back over those factors, and you're right. But it doesn't matter. It's low is low. In other words, the thing about labor force participation is a very simple calculation. You say how many people are working. That's the numerator, and how big is the labor force. That's the denominator. That's all it is. Now it's never 100%, right? Because there are students and homemakers and retirees and others. There are good reasons for some people not to be in the workforce at any given time. But as recently as 2000, that number was 70%. What drove it between approximately 1975 and 2000 was basically women entering the workforce, women who had been home, as homemakers or, performing other roles, entered the workforce, and then that number went up. So, like I said, it's never 100, but 70 was very strong. 62 is down a lot. I mean, that's about a 14% decline. Look, GDP, the standard definition is, it's consumption plus investment plus net exports plus, government expenditure, like a 4-part thing. Yeah, but there's a simpler way to do it, which is how many people are working, how productive are they? Just who's working and how productive are they? That equals nominal GDP. And if you have fewer people working, the economy is going to shrink unless productivity is going up, which it's not. And so this is one of the major headwinds. Now, you're right. There are some early retirees. There were a lot of people who stayed home, obviously, during COVID, and it's very well studied and clear that working is a habit. It's a good habit, I think, for the most part, but it's like any habit. Once you break it, it's hard to go back. So once you get used to not working or working from home or, we're just staying home, the government was handing out checks, beginning with Trump in, I believe it was June 2020. Everybody got that one was a $1,400 check. And then in December 2020, at the end of the Trump administration, everybody got a $600 check. And Biden comes in February 2021, not to be outdone. He hands out, I think, a $1,600 check. So everybody got a check, like 2 or 3 of them. And a lot of younger people opened accounts on Robinhood and started trading Bitcoin. That didn't work out too well. But a lot of people saved the money. But there were very definite spikes in retail sales coming within 30 days of the checks. Well, that's not surprising. I give people free money, they'll go buy stuff. And that kind of kept the economy going. It wasn't a real boom, but it looked good. But we're not doing that anymore. There's no more checks. And so you had a lot of people lost the habit, a lot of people staying home, watching, maybe the World Series or whatever, eating Doritos, but they're not working. And a lot of people out of the habit, but they just got used to government handouts. Not everybody, but some. And the other problem is, because people say, wait a second, how can you have low labor force participation when everywhere you look, there are help wanted signs, which there are. I mean, McDonald's is paying $35,000 for an entry level, like cashier or hamburger, maker, with benefits, training, and advancement. Well, that's pretty good for, entry level hamburger person. So there are and people call this a labor shortage. There isn't actually a labor shortage because we just talked about how you've got perhaps as many as 10 million, people between the ages of 25 and 54 who are sitting home. But the problem from the employer's point of view, there's a shortage of willing workers.
Willing workers, yeah.
Not workers, but willing workers. Well, what makes you willing to work? Well, a raise, a good pay is one. As employers can't afford to pay the clearing wage to get people off the couch because they'll go bankrupt themselves. They're working on very small margins. Sales are declining, et cetera. So I'll pay as much as I can to get the workers, but it's not enough to get this person off the couch, so to speak. And so you've got this really weird situation. I use weird in the technical sense, where you have a huge pool of able-bodied, potential workers, but a shortage of willing workers because you can't pay a clearing wage. But that's more a reflection of how stressed businesses and how low margins are. And then you look at the big names. I mean, I guess Twitter is the most recent, but, Amazon, FedEx, Target, they're all looking at big layoffs and they're
big layoff announcements coming every day. So, none of which is good for the U.S. economy. But, the Fed looks at unemployment. I mean, I look at it because you're supposed to know what it is. I mean, I always say, if you're trying to forecast the Fed, you got to look at the world the way they do, even if it's messed up. Like, even if they're looking at the wrong things, which they are, as an analyst, you have to look at them to figure out what they're doing. That's how you do intelligence work. Think like the other guy. But then once I take my Fed hat off and say, well, what do I think? The unemployment rate's almost irrelevant. First, that's a lagging indicator. Secondly, it ignores what we talked about with labor force participation. There is no Phillips curve. I mean, you can draw one. Last time I saw a Phillips curve was flat. Or I went to school, curves weren't flat. But but they're just looking at the wrong indicators.
You brought up chapters 1 and 2 from Currency Wars, where you basically highlight this scenario. You said the scenario you presented at the time was that Russia and China would accumulate large gold reserves, pool their gold, and launch a new digital currency backed by gold in the place of the U.S. dollar. Is that the form it would take for you, something backed by gold?
Probably, and here's why. And by the way, when I wrote that, when we did the war game, and when I wrote that, Russia had about 600 tons of gold, and today they have 2,300 tons. China had about 600 tons of gold, and today they have about 2,000 tons, just slightly less, that we know of. And they may have several thousand tons off the books in the State Administration of Foreign Exchange that we don't know about, because that's completely opaque. So Russia and China did exactly what we warned the Pentagon about in 2009, exactly, which is increase their gold reserves by a factor of 4 or more. But everyone's like, well, the Chinese yuan is going to be the global reserve currency. No, and it's not going to be the ruble. But here's why. Well, there are a lot of reasons, but the main reason is, when you talk about reserve currency, you have to understand what that means. It's not like the People's Bank of China has a bunch of $100 bills on pallets stacked up in the basement. When people say reserve currency, what they really mean is the currency of the bonds that they invest in. In other words, they're dollar-denominated assets in the form of treasury bonds or notes. That's what China actually has on their books, not like the dollars per se. So if you want to suggest or hypothesize that the Chinese yuan is going to replace the US dollar as a global reserve currency, where's the yuan bond market? I mean, it doesn't exist. Very small scale, very illiquid, no primary dealers, no win issue trading, no auctions, no repo, no settlement clearance, none of the plumbing and the mechanics of a mature bond market such as the United States. And above all, they don't have a rule of law. I mean, at least if somebody reneges on a treasury bond, you can sue somebody, but you can't do that in China. So the absence of the rule of law, number one, the absence of the infrastructure, the plumbing, for want of a better word, are two reasons why the yuan and certainly the ruble will not replace the dollar as a reserve currency. However, what I was hypothesizing then, and I'd come back to this, is you can create a brand new currency that does have all that stuff. And in my example, they used a Swiss bank, UK law, put the gold in a third-party depository. If you wanted some of the new currency, you could deposit your own gold and get some of the currency or trade with them or run a surplus. So it was a replacement system, but you would need the gold to instill confidence. But they don't have bond markets, so they're not going to have them soon. So the yuan and the ruble aren't going to replace anything.
In the terrifying picture you've just painted, Jim, how should we be protecting ourselves here?
Well, you want assets that are going to be immune from a global liquidity crisis. What are they? Land, real estate, gold, silver, fine art. I see Andy Warhol, Marilyn Monroe has gone. They estimate $200 million. You could have bought that for $50,000 in the 1970s. That's a little more specialized, but there are, natural resources, water, et cetera, energy, oil. If you want to be in stocks, okay, get stocks of companies that are based on natural resources, such as ExxonMobil, Chevron. I mean, I'm just giving these as an example. But so there are a lot of ways to protect yourself. But a regular stock portfolio is not a good one, and banks are going to be in distress. Money market funds are going to be in distress. That's what a liquidity crisis is.
We seem to have a huge chunk of our working age population that is not working. And you probably study this more than most people. Like, what's truly going on there? Do we have is it just an aging population that truly can't work? I know that disability has it's seen massive growth over the past 15 years. Are there a bunch of people that are opting out or gaming the system or whatever? But what's responsible for us only having 62% of our working age population actually engaged in working?
Well, there are two answers to that, but they're consistent. I'll give you both. The short answer is it doesn't matter. You listen to a number of factors. I'll go back over those factors, and you're right. But it doesn't matter. It's low is low. In other words, the thing about labor force participation is a very simple calculation. You say how many people are working. That's the numerator, and how big is the labor force. That's the denominator. That's all it is. Now, it's never 100%, right? Because there are students and homemakers and retirees and others. There are good reasons for some people not to be in the workforce at any given time. But as recently as 2000, that number was 70%. What drove it between approximately 1975 and 2000 was basically women entering the workforce, women who had been home, as homemakers or, performing other roles, enter the workforce, and then that number went up. So, like I said, it's never 100, but 70 was very strong. 62 is down a lot. I mean, that's, about a 14% decline. Look, GDP, the standard definition is, it's consumption plus investment plus net exports plus, government expenditure, like a 4-part thing. Yeah, but there's a simpler way to do it, which is how many people are working, how productive are they? Just who's working and how productive are they? That equals nominal GDP. And if you have fewer people working, the economy is going to shrink unless productivity is going up, which it's not. And so this is one of the major headwinds. Now, you're right. There are some early retirees. There were a lot of people who stayed home, obviously, during COVID, and it's very well studied and clear that, working is a habit, it's a good habit, I think, for the most part, but it's like any habit. Once you break it, it's hard to go back. So once you get used to not working, or working from home, or, we're just staying home. The government was handing out checks, beginning with Trump in, I believe it was June 2020. Everybody got that one was a $1,400 check. And then in December 2020, at the end of the Trump administration, everybody got a $600 check. And Biden comes in February 2021, not to be outdone. He hands out, I think, a $1,600 check. So everybody got a check, like 2 or 3 of them. And a lot of younger people opened accounts on Robinhood and started trading Bitcoin. That didn't work out too well. But a lot of people saved the money. But there were very definite spikes in retail sales coming within 30 days of the checks. Well, that's not surprising. I give people free money, they'll go buy stuff. And that kind of kept the economy going. It wasn't a real boom, but it looked good. But we're not doing that anymore. There's no more checks. And so you got a lot of people who lost the habit, a lot of people staying home, watching, maybe the World Series or whatever, eating Doritos, but they're not working. A lot of people out of the habit, but they just got used to government handouts. Not everybody, but some. And the other problem is, because people say, wait a second, how can you have low labor force participation when everywhere you look, there are help wanted signs, which there are. I mean, McDonald's is paying $35,000 for an entry level, like cashier or hamburger, maker, with benefits, training, and advancement. Well, that's pretty good for, entry level hamburger person. So there are and people call this a labor shortage. There isn't actually a labor shortage because we just talked about how you've got perhaps as many as 10 million, people between the ages of 25 and 54 who are sitting home. But the problem from the employer's point of view, there's a shortage of willing workers.
Willing workers, yeah.
Not workers, but willing workers. Well, what makes you willing to work? Well, a raise, a good pay is one. As employers can't afford to pay the clearing wage to get people off the couch because they'll go bankrupt themselves. They're working on very small margins. Sales are declining, et cetera. So I'll pay as much as I can to get the workers, but it's not enough to get this person off the couch, so to speak. And so you've got this really weird situation. I use weird in the technical sense, where you have a huge pool of able-bodied, potential workers, but a shortage of willing workers because you can't pay a clearing wage. But that's more a reflection of how stressed businesses and how low margins are. And then you look at the big names. I mean, I guess Twitter is the most recent, but Amazon, FedEx, Target, they're all looking at big layoffs, and big layoff announcements coming every day. So, none of which is good for the U.S. economy. But the Fed looks at unemployment. I mean, I look at it because you're supposed to know what it is. I mean, I always say, if you're trying to forecast the Fed, you got to look at the world the way they do, even if it's messed up. Like, even if they're looking at the wrong things, which they are, as an analyst, you have to look at them to figure out what they're doing. That's how you do intelligence work. Think like the other guy. But then once I take my Fed hat off and say, well, what do I think? The unemployment rate's almost irrelevant. First, that's a lagging indicator. Secondly, it ignores what we talked about with labor force participation. There is no Phillips curve. I mean, you can draw one. Last time I saw Phillips curve was flat, or I went to school, curves weren't flat. But that's, but they're just looking at the wrong indicators. Global economy is the big topic. That's what we all care about most. But financial markets can come up with their own narratives and go their own way, at least for a while. So you have to, they're not in sync. They will be in sync eventually, but not always right away. A lot of times the financial markets get ahead of themselves and then they wake up to reality and they, crash, correct down. So there's a little bit of that going on. But in terms of the global economy, I think your use of the word global is very much on point, because we are going into, or may already be in, a global recession. Now that's rare. It's rare when, China, Japan, US, Germany, they're all in recession at the same time. But that's what's unfolding. That's a big deal. Well, for obvious reasons, because, it affects basically everyone, but, there's no life preserver. There's no, it's not like China's going to pull us all out of it with cheap exports, or Japan's going to, put the pedal to the metal in terms of fixed, asset investment, et cetera. So that's a really bad sign. I mean, and just to be very specific, we just saw U.S. fourth quarter GDP grew at a 2.9% annualized rate. People are like, yeah, it's pretty good. And, it's not good by post 1980 standards. It's not good at all by post World War II standards, but post 2008, yeah, that's not bad. Again, you have to disaggregate it and you look at what grew. It was, inventories were a big contributor, and net exports were a big contributor. And fixed asset investment in particular, there was a big load of aircraft orders for Boeing, which is notoriously lumpy. They'll have a big month, blowout month, and then nothing for a couple of months, not nothing, but something very low. So when you look at that, inventories are counted as part of GDP, of course, but it's not necessarily a good thing. If inventories are piling up, it means retailers are not buying. And this kind of goes back to the whole supply chain breakdown of a year ago. That's what my book Sold Out was about. So you go back to, let's say, the spring of 2022. The supply chain had completely fallen apart. And if you were a purchasing manager and you were saying to yourself, okay, we're kind of coming out of COVID, we're going to start growing, but the supply chain is broken. So instead of ordering one, container, I'm going to order 3 containers because maybe one will get through, through the bottlenecks. I only want one, but I'm going to order 3 and hope for the best. What happened was a lot of the stuff was alleviated, not for good reasons, not really for logistical reasons, but because the consumers slowed down a lot beginning in June, partly in reaction to the Fed starting to hike rates in March of 2022. And then here come the 3 containers. So at the exact moment when demand destruction is kicking in, your inventory is going to the rafters. So what do retailers do, or wholesalers for that matter, but retailers, they slash prices, that, 2-for-1 sales, because inventories are a nightmare for retailers for obvious reasons. Number one, you have to finance them, so they eat up working capital. It could be cash, but now you got a bunch of stuff in the back office. And number two, it just takes up space. I mean, insurance costs and other costs like that. But the other thing people kind of underestimate is that, like, fashion stuff goes out of fashion. Last spring's styles are not next spring's styles. You still got last spring stuff. Good luck. We're getting close to spring, so you're dumping that stuff. Consumer electronics, you got an iPhone 13. Well, everybody wants an iPhone 14, whatever. I mean, you take the point. So piling up inventories is a very unhealthy sign. It means the retail sector is drying up, demand destruction is kicking in, costs are going up because you got to finance all this stuff, and your profit margins are going down. So I don't take a lot of comfort from that. But the other thing, to the extent you can disaggregate monthly data, and there's a lot of monthly data, 2.9% annualized for the quarter, but it really slowed down in December. Christmas was a disaster. I mean, people bought stuff for Christmas, but way below expectations. And again, it goes back to piling up the inventory at the worst possible time. So it looks like the U.S. is going into 2023. Possibly a recession started in December. If not, we expect it to start soon. But you're seeing the same thing in Europe now. Europe got a break with the weather. Obviously there's a war going on, so that's a big factor. But, and natural gas prices skyrocketed and oil prices skyrocketed again in mid 2022. They've come down, but it doesn't mean that, all is well or they're out of the woods. And there are other things going on. China is a basket case. They went from zero COVID. It was bad public policy and bad health policy, but they did it anyway. So they flipped almost on a dime. So they just turned on a dime and said, okay, let it rip. The policy, let it rip. Okay, let everyone get infected and we'll do the best we can. One of the ways you get through it is by letting it rip, and you develop what's called herd immunity. And that's what worked in North America and Europe. But the other difference between China and Europe and the U.S. is that they don't have the healthcare system to deal with it. Our healthcare system, which is pretty good, was strained. Same thing in Europe. China has nowhere near the ICU units, the oxygen, the treatments, the professionals, the nurses and doctors, not even close. And when you get out to the village level, which is where most of the people still live, believe it or not, they often have nothing. But that is hurting the economy as much as the zero COVID. They had no good ways out. I'm not saying one's better than the other. They're both awful, but you still have a lot of things that are not COVID. The real estate collapse, the excessive debt, the demographic decline, just the impact of top-down management when you can't possibly get everything right, and decoupling from the U.S. and the U.S. cutting off, high-tech exports to China, including third country exports where they're relying on U.S. licenses or equipment. So China's in a deep hole, probably in a recession. Japan, same thing. So the global economy is in bad shape. It's going into a recession. Now, a lot of people have said that, we're going to have a recession as if it's no big deal, but they're expecting a mild recession. I see a much more severe recession. Now, the other half, what does this mean for financial markets? And there, the best way I've been able to explain it, imagine you're in an Irish pub and you got three Irish storytellers. And I'm part Irish, so I can talk about the Irish, but they're telling three different stories and you got to listen to each one. So there's the Fed story, the market story, and then there's something called reality, what's actually happening. So stock market's telling us Goldilocks, bond market's telling us, here comes, Hurricane Mitch or whatever. And then, there's what I call the reality. And I guess I'm a storyteller here, but, what I see is a kind of a hybrid. The Fed's doing what they're doing, right or wrong. Okay. They're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed has probably over-tightened. They probably are at the, so-called terminal rate. They just don't know it. They're going to keep going for the reasons I explained. That means they're going to make it worse. They're going to make the recession even worse. And they may pivot, to say that there could be a rate cut. It won't be in April, but, rate cut in August, maybe. I wouldn't rule that out, but for a really bad reason. In other words, if the Fed cuts rates, which they may, the pivot may be real. It's not because they engineered a soft landing and Goldilocks and everything. Oh, that's just right. It's because they screwed up as usual, as they've been doing since 1913. They over-tightened and they found out too late. And then they have to slam on the brakes or take the foot off the brake, if you will, in terms of rate hikes and then pivot. And we've seen this movie before. This is exactly what happened in 2018. The stock market dropped 20%. I mean, it's like 19.9 or something on the Dow. So maybe not technically a bear market, but yeah, what's the difference? It dropped 20%. The Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre. And after most of the 20% collapse had already happened, they tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market, this whole, Bernanke put and Greenspan put and all that. That's not how it works. they don't care that much about this. The supply chain was breaking down before COVID. Now, of course, COVID made it worse, yes. And the war in Ukraine made it worse, yes. But this really started with Trump's trade war in 2018. That, like I said, there's a thread that runs through all these things. So not to throw out my hands, I'm not going to do that. But when you ask me that, I'm thinking, well, you know, talk about China, Ukraine, supply chain, Biden, they're all a big deal. You know, in terms of tragedy, probably the war in Ukraine is the most important because it's highly, highly significant economically and strategically. But of course, it's a human tragedy going with it. You know, if Chinese real estate implodes, okay, there's some hardship here and there, but it's not like people being killed or maimed or forced into refugee status. And that is part of what's going on in Ukraine. So that's probably the biggest single one, but I wouldn't miss the fact that all these things are going on at once. The number one question, of course, everyone's concerned about inflation, but there's a big backstory there. But I always say, when it comes to your own money, everybody has a PhD in economics. You don't need Larry Summers to tell you what's going on with your budget and your, you know, ability to feed your family or keep a roof over your head. So people get inflation. One of the reasons it's so politically toxic is because it's unavoidable. You can't fudge it. You can't spin it. It's like, hey, if I used to fill up my Ford F-150 truck for $50 and now it's $125, A, you get it. It's right in your face. And B, that's $75 that you don't have to take your spouse out to dinner, you know, buy a new jacket or whatever. So there's kind of demand destruction at the same time you're spending more money on the one thing you can't do without. So people get it. But then from there, the question I get the most is, hey, Jim, is this going to cause a recession? Are we going to have a recession? And as recently as a few months ago, I would say, yeah, I think so. You can see it coming late this year, early next year. Now I say, we're in a recession. I mean, it's not coming, we're in it. And there's data. I never make statements like that, Brian, without supporting it. So the standard definition of a recession is 2 consecutive quarters of declining GDP. There are a few more bells and whistles having to do with unemployment and a few other things, but that's the rule of thumb. So based on that, based on the best available estimate for a second quarter, likely to be accurate, we're in a recession today. Now, it's not severe, but that's like saying I'm in bed with pneumonia, but I'm not dying. Well, okay, but we're in a recession right now. And there's a lot of whistling past the graveyard. I mean, the stock market is still, greatly overpriced. There's still, the buy the dips mentality hasn't gone away. It's still there. You got people like Jim Cramer yelling, buy Netflix or whatever. And, there's institutional support. There's momentum trading. Of course, 95% of the trading is by robots. So you got to reverse engineer the 27-year-olds from Bangladesh who don't get out much. They're the ones really writing these algorithms. Brilliant engineers, but, you'd have to show them around Wall Street. So all that's going on. So we haven't really seen the market collapse, stock market collapse that I would expect in association with a severe recession has not happened yet. This is just going to play out. It'll get worse as the year goes on.
All right. So you're expecting a major correction in stock markets on the back of a recession. I'm not alone.
I mean, that is my expectation. I have my own models and I look at it closely. But if you listen to Michael Burry, Jeremy Grantham, Charlie Munger, these people have been around and they run, hundreds of billions, and they're saying the same thing. So every now and then someone will throw some statistic at me and I go, how long is your time series? And I go, we took it back 5 years. I was like, talk to me if you've done it for 100 years, because that's a little more meaningful. But Jeremy Grantham actually did do a 100-year time series and looked at bubbles all over the world, 1929 US, 1989 Japan, 2000 dot-com stocks, and many others. And he said he's never seen anything like it. It's a triple greatest bubble of all time times 3 in the sense that it's real estate, stocks, and other asset classes. So, I do. That is my view, but it's shared by a number of other analysts.
And that would mean like S&P coming off another 20, 30%?
Yes. And again, you have to remind people, 1929, everyone's like, October, I think 18th or 19th, it was late October 1929, the stock market fell 22% in 2 days. It wasn't one day. It was, it was like 12% one day, 11% the next day. So 23% over 2 days. But that wasn't the crash. That was the beginning of the crash. This Dow Jones fell 82% from top to bottom. Now, it took 3 years. It bottomed in June 1932. Started in October 1929, so not quite 3 years. But that fell 82%. And that happens. So, we're down, NASDAQ's down, bounced back a little bit in recent days, down close to 30%, down the S&P down over 20%. We're in bear market territory, but that's just the beginning. That's not what a full bear market, market adjustment looks like in the face of the kind of recession that I expect.
Talk to me about inflation, because, I was looking at some of the inflation numbers, and you have to go back to the 80s to see anything that's approaching double digit. I remember being just a kid hearing about double digit inflation. I could kind of remember the gas pumps, the lines at the gas. It's like a distant memory of me in the 70s. But how do you talk to younger people these days about what inflation is or it means? Because I don't think people really grasp what it actually means to your savings or to the economy in even a medium term.
Well, that's exactly right, Brian. And if you're a little younger than I am, but I lived through it. I started my career in banking in 1976. And I remember my wife and I used to kid each other. She was in advertising, I was in banking, and the inflation was so bad, you'd get a raise every 4 or 5 months. And you didn't have to ask. They would just give it to you because they knew that you were going to quit if they didn't keep up. So she would get a raise, and she was making more than I was at the time. So we'd go out to dinner, and I would get a raise, and I was making more than she was. So we would just tease each other about that. But that's how it was. And the psychology was, if you needed a TV set or refrigerator, new car, whatever, you say, I better buy it now because the price is going to be higher. If I wait a month or 2 months, the price is going to run away from me. So it had huge behavioral effects. Of course, gold was, going to the moon. There was a lot going on at the time. But Brian, you're right when you say we're putting up inflation numbers today that are the highest in 40 years. That is correct. A little 41, actually, it was 1981 before we saw these numbers. But I remind people, the inflation in 1981 was the end of a 10-year period of inflation. It wasn't the beginning. You say, that's some inflation. Yeah, we did. But it had started. In some ways, it started in 1968, and it really took off in 1974, 75. So 81, these numbers, that was when Volcker finally got it under control. But you go back to 80, 70, between 77 and 81, so that 5-year period, the dollar lost 50% of its purchasing power. Not 15, 50 in that 5-year stretch. So you were putting up numbers, 10%, 11%, 13% and higher year after year. Yeah, 1981, it was, 9 or 10, which is what they're comparing to today. But that was on the downslope. It had been higher than that in 77, 78, and, 79. So the question is this the beginning of an inflationary surge where it's going to get even worse and it is going to last 5 years? Or is it different than that? But keep that in mind, because the 40-year comparison, it is correct, but that was the tail end of an even worse episode. And again, there is this comparison to the 70s. By the way, I think the situation we're in today is very different from the 1970s, and I'll explain why. In the 70s, it was triggered from the supply side with first the Arab oil embargo in 1973 as a result of the 1973 Arab-Israeli war. And then the price tripled, but it went from $2 to $6. Okay. But, percentage terms, that's a huge jump, but it was still $6. And then it got to 12. And then in 1979, you had a second oil embargo because of Iran and the Ayatollah and the revolution and the hostages and all that. And then it went from kind of 12 to 20. So oil went up by a factor of 10 in the course of the late 70s because there's two different embargoes. So that's coming from the supply side. But what happened was the other source of inflation is on the demand side. So you have what's called cost push inflation. That's where, supplies choked off, or there's an embargo, or there's a shortage, natural disaster, a lot of things. It's coming from the supply side, and demand is inelastic. So you just pay up or, kind of do without. But the demand side is much more psychological. That's called demand pull inflation. That's when consumers behave the way I described. And as I said, I lived through the 70s, where, hey, I better buy it today. I better buy it now. You're pulling all this demand forward and bidding up prices because you're worried that it's going to get even worse. So as that applies to today, we are starting with the cost push inflation, mainly the price of energy, but the price of food is a big factor. And of course, they're related. It's like, here's the energy, here's the food. Where do you think the food comes from? To get the food, you got to feed the pigs and cows. What do you feed them? You feed them corn. How do you get corn? Well, you grow it on a farm. You need nitrogen fertilizer. You need diesel in your tractors. You get the food, you got to put it in a truck to get it from point A to point B. That requires diesel. The higher the diesel price, the higher the cost of food because you're moving it by truck, etc. So these things, as I say, are linked. But food prices are going up substantially, and the two things you can't do without are